Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Friday, June 12th, 2026. We're Elena and Marcus.
Imagine you're betting heavily that a localized kitchen fire is, actively being put out. But at the exact same time, you are paying top dollar for whole house fire insurance.
Right.
That is exactly the bizarre contradiction we are seeing in the markets today.
Yeah, it really is. Let's lay out exactly what you need to know from today's data deck. We are tracking 4 critical themes that are basically fundamentally repricing risk across the board.
Indeed.
First, we have geopolitical de-escalation. So the momentum behind a U.S.-Iran peace deal is pushing oil lower and driving a massive cross-asset risk-on trade.
Right, risk on everywhere.
Exactly. Second, landmark equities action. We are dissecting the historic $75 billion SpaceX IPO, ticker SPCX, its immediate ripple effects on market liquidity, and, well, the ongoing structural shift punishing software valuations.
Mm-hmm.
Third is global rates divergence. The European Central Bank just delivered its first rate hike in 3 years, and that stands in stark contrast to the Federal Reserve's higher for longer holding pattern.
Yeah. Totally different approaches right now.
And fourth, the hard asset disconnect. We will examine why gold remains, stubbornly elevated in a session where equities are rallying and oil is plunging.
Moving to today's data, we really need to start by examining the bedrock of today's moves, which is global interest rates.
Right, because everything flows from that.
Correct. The cost of capital dictates the equity and commodity reactions we will unpack later. So let's begin in Europe. The ECB raised its deposit rate to 2.25%.
Yeah.
That is their first hike in nearly 3 years.
And, looking at our daily desk data, the market had fully priced in this specific move. It wasn't a shock.
No.
Yet the tone from ECB officials following the decision was notably hawkish, which definitely caught some desks off guard.
Correct. Officials like Nagel and Casimir signaled a readiness to continue hiking if necessary. And the justification lies in the revised macroeconomic forecasts. They issued a deeply stagflationary revision, downgrading 2026 GDP expectations to 0.8%.
Okay, wait, let me stop you there.
Sure.
They are actively downgrading growth to under 1%, but still hiking rates.
Yep.
I mean, stagflation is notoriously difficult to manage, but hiking into a growth slowdown goes against everything a central bank usually wants to do to save an economy.
Yeah, it does.
Walk us through why their hands are tied here. Let's get to the first principles of this.
Well, it is the central banker's worst nightmare. You have an economy slowing down, which, as you said, traditionally demands lower interest rates to stimulate borrowing and investment.
Right.
But they are facing a broadening energy shock that is driving up prices across the continent. So if they cut rates to save growth, their currency weakens.
Which makes importing energy even more expensive.
Exactly. Which worsens the inflation. They are trapped. They are prioritizing the fight against inflation, hoping to prevent a wage price spiral, even if it means deliberately stalling their own economic engine.
Wow. I mean, that brings us to the U.S. Treasury dynamics. Our latest run of desk data shows traders amassing a record bet on higher rates ahead of the upcoming FOMC meeting.
Yes.
The institutional consensus has now pushed expectations for the first Federal Reserve rate cut all the way out to June 2027.
And the curve dynamics reflect that exact sentiment. We're looking at a positively sloped steepening curve.
Yeah.
The 10-year, 2-year spread sits at positive 39.4 basis points.
Right.
Meanwhile, at the long end of the curve, the 30-year Treasury yield is approaching a critical technical level, currently sitting just below 5%, specifically around 4.974%.
We did get one crucial piece of domestic data today that fed into this equation, right? The University of Michigan sentiment print.
We did, yeah.
It came in at 48.9, beating expectations. But the underlying detail that institutional desks are really focused on is the meaningful decline in the 5 to 10-year inflation expectations.
Which dropped pretty significantly.
Right. They dropped from 3.9% down to 3.4%.
Indeed. A 50 basis point drop in long-run inflation expectations in a single month is substantial. It provides the bond market with modest relief because, well, long-run inflation de-anchoring has been the primary fear for the Fed.
Sure, because if consumers believe inflation will stay high forever, they demand higher wages.
Correct, which creates a self-fulfilling prophecy. This drop suggests that psychological anchoring is actually holding. However, it clearly wasn't enough to pull the 30-year yield away from that 5% threshold.
Okay, let's unpack this with a first principles perspective, because there is a mechanical disconnect here that often trips up regular investors.
Yeah.
Why exactly is the 30-year yield creeping toward 5% when the Fed's overnight rate is expected to stay flat? And, long-term consumer inflation expectations just dropped.
That is the essential question. So the Fed directly controls the overnight borrowing rate. That is the very short end of the curve.
Right.
But the 30-year yield is determined by the open market. It reflects the compensation that institutional investors demand for locking up their capital for 3 decades.
Okay.
When you see the 30-year creeping toward 5%, the market is demanding a higher term premium.
Meaning they want to be paid more just for the risk of time itself.
Exactly. They are looking at deeply embedded structural risks. We have massive deficit spending from the government, the deglobalization of supply chains, making manufacturing more expensive, the immense capital requirements needed to build out the AI transition.
Right. All of that infrastructure.
And persistent geopolitical instability.
Yeah.
The market is effectively saying that regardless of what the Fed does with overnight rates next month, the structural baseline for inflation over the next 30 years is fundamentally higher.
Understood.
Long-term yields are completely separate from the Fed's near-term policy decisions. They are pricing in an entirely new era of capital scarcity.
So if institutional money is demanding a 5% premium to lock up cash for 30 years, you would think equities would be starving for capital today.
You would.
But they aren't. In fact, we just saw the exact opposite happen with a massive liquidity event.
Moving to today's data on sector and equity flows, we have to look at the primary catalyst here, the SpaceX IPO.
Ticker SPCX. It opened at $150, which was an 11% premium to its $135 IPO price, and it closed the session at $160.95, up nearly 19%.
Yeah, a massive move.
This was a $75 billion capital raise. It is the largest in history, vaulting SpaceX to a $2.2 trillion fully diluted market cap.
A $75 billion capital raise is it's a gravitational anomaly. It literally bends the market around it.
Right.
Our proprietary updates show that this IPO absorbed immense institutional capital, but the underlying flows reveal a distinct rotation. Space-adjacent peers, the smaller rocket, satellite, and space infrastructure names that rallied all month in anticipation of this event, they actually sold off sharply today.
Let's explain how that money physically rotates. Because when a massive entity like SpaceX finally goes public, institutional managers have strict portfolio weighting limits.
Right.
They cannot just print new money to buy SPCX. They have to find that cash somewhere.
Correct. Capital exited the proxies and consolidated directly into the new mega-cap leader. Managers had been hoarding those smaller space infrastructure companies as a way to get exposure to the sector while waiting for SpaceX.
Yeah, they were just using them as stand-ins.
Exactly. Today, they dumped the stand-ins to buy the main event.
Even despite that massive absorption of liquidity at the top, market breadth was notably positive today. The Russell 2000 outperformed the cap-weighted S&P 500.
Which is a very healthy signal.
Right, that indicates broad participation across small and mid-cap companies, rather than the rally being concentrated solely in a few tech heavyweights.
On that point, the most aggressive risk-on expression happened overnight in Asian equities.
Oh, yeah.
The Kospi surged over 8% intraday.
That is a staggering move, the most dramatic single-session move in the region in recent memory. And to translate why that happened from trading desk speak, major institutional desks piled into Korean exporters, treating the Korean market as a highly sensitive barometer for global trade and energy input costs.
Yes, because South Korea is heavily dependent on imported energy to run its vast industrial and manufacturing sectors.
Right.
So lower oil prices map directly to expanded margins for their industrial base.
Right.
Major institutional desks utilized Korean equities as a high beta expression of Middle East peace deal optimism.
Yeah.
A drop in crude oil is essentially a massive immediate tax cut for the entire South Korean economy.
Got it. And this brings us to the stark divergence we are seeing within the technology sector itself. The debate between software and hardware evaluations is, it's really intensifying.
It definitely is.
Yeah. Our daily desk data highlights Adobe. The stock dropped 5% today, despite the company actually raising guidance for future revenues and earnings ahead of street expectations. We are also seeing residual downward pressure on Oracle following their earnings earlier in the week.
What we are observing is an ongoing multiple reset across the software sector. The market is heavily rewarding hardware and compute while heavily penalizing software.
Yeah.
The structural argument driving institutional consensus is that software ultimately depends on the production of intelligent code. As artificial intelligence models improve, the ability to generate code is moving from a state of scarcity to a state of abundance.
Right, so code is becoming cheap.
Exactly. If intelligence becomes cheaper, more open and local, the pricing power of traditional software companies erodes, even if their near-term earnings currently hold up.
Okay, I am going to push back on that structural thesis.
Okay, let's hear it.
Is the market prematurely punishing software multiples under the assumption that AI code generation is becoming a cheap commodity right now? I mean, in reality, AI implementation still requires massive, scarce human engineering effort today.
That's true.
Integrating these models into enterprise workflows is highly complex. It feels like the market is pricing in a 2030 reality for software companies in 2026.
I see your point. The implementation friction you mentioned is very real, but institutional capital is forward-looking. The reason they are rotating from software to hardware is that market signals in the physical world prove compute remains genuinely scarce right now.
Meaning we can measure it.
Yes, we do not have to guess about hardware demand.
Right.
We can monitor server rental prices and data center utilization rates. Those metrics remain elevated.
Right.
Higher hyperscaler capital expenditure forecasts only matter if the market price of compute stays high. Right now, compute is the physical choke point, whereas software capabilities are diffusing rapidly. That is why the multiple compression in software is happening simultaneously with the hardware expansion.
Moving to today's data on commodities and hard assets, we can connect that equity optimism, particularly that massive cost-based surge, directly to the physical catalyst in the real world. The pricing of energy and hard assets shifted violently today.
The central driver was WTI crude settling below the $85 threshold, closing at $84.24 per barrel.
Right.
The primary catalyst was a statement from a Pakistan official confirming that a final agreed-upon text of the U.S.-Iran peace deal has been reached.
And the physical reality on the water is actually reflecting that diplomatic progress. Our latest run of desk data confirms that roughly 7 million barrels a day are now flowing through the Strait of Hormuz.
Yeah.
That is about half of the pre-war volumes, marking a significant physical de-escalation of the blockade that has constrained global supply since late February.
On that point, there's a substantial counterweight to this optimism. Chevron CEO issued an explicit warning today that global oil inventories are heading toward uncomfortable levels.
Right, because of the SPR.
Exactly. The U.S. has exported nearly 22 million barrels from the Strategic Petroleum Reserve overseas so far in 2026 to stabilize prices during the blockade.
You cannot sustainably balance global energy markets by draining your strategic emergency fund indefinitely. Chevron is signaling that once the SPR drawdowns stop, the underlying supply deficit remains severe.
Indeed. And this brings us to the Haven disconnect. We have plunging oil and surging risk assets, yet metals are telling a very different story.
Yeah, completely different.
Copper remains elevated at $13,575 per metric ton, which ties directly into the structural AI and hardware data center demand we just discussed, along with resilient industrial demand from China.
Right.
Silver sits at $68.02. But the standout is gold. It remains extraordinarily elevated at $4,219.33 per ounce.
The gold market is just refusing to sell off. In a pure risk-on session driven by geopolitical de-escalation, gold should mechanically reprice lower as fear leaves the market.
It should.
The fact that it is holding at over $4,200 signals that institutional capital is maintaining a massive haven premium. Let's go back to our analogy from the beginning of the briefing. Compare the market to a homeowner dealing with a localized fire.
Okay.
Oil dropping below $85 means the homeowner believes the fire in the kitchen, representing the Hormuz blockade, is actively being put out by the authorities. But gold remaining at $4,219 means that same homeowner is still paying maximum price for whole house fire insurance.
They don't trust it.
Exactly. The market is not actually convinced that the broader geopolitical tail risk is extinguished. They are happy to trade the near-term relief in equities and oil, but they are retaining their catastrophic insurance policy just in case the foundation is still wired to blow.
Correct. That is the precise dynamic. The peace deal involves a 60-day technical negotiation timeline. It's a deal to make a deal. Gold traders are looking at the timeline, looking at the structural inventory deficits Chevron highlighted, and deciding the structural risk remains incredibly high.
Let's pull this entire macroeconomic picture together in the synthesis. We have a complex board today. Rising long-term interest rates with the 30-year testing 5%. A landmark risk-on equity environment fueled by the SpaceX IPO. plunging oil on peace deal momentum, yet stubbornly high gold and dollar positioning.
Connecting the dots across these asset classes reveals the broader economic regime institutional consensus is currently pricing in. The market is positioning for a soft landing with persistent inflation.
Which basically means they expect economic growth to hold up, avoiding a deep recession. But they have accepted that prices are going to keep rising faster than we were used to in the previous decade.
Correct. The momentum toward a peace deal provides the catalyst for growth recovery and near-term inflation relief by lowering energy inputs. That explains the equity rally and the oil sell-off.
Right.
However, the bond market and the hard asset markets are signaling that structural risks are deeply embedded. The fact that the 30-year Treasury demands nearly a 5% yield and gold commands over $4,200 an ounce confirms that the baseline for inflation and volatility is permanently higher than the pre-war era.
On that point, the currency market is highlighting a very specific vulnerability right now. The US dollar index, the DXY, is hovering near 100. Our daily desk data shows that hedge funds and asset managers are currently holding $27.8 billion in net long positions on the dollar.
That's a massive position.
It is. That is the highest level of bullish dollar positioning since February 2025.
The dollar is functioning in a dual role right now. It is capturing haven demand due to the geopolitical uncertainty, and it is capturing yield demand because the Federal Reserve is holding rates higher for longer.
While central banks like the ECB have begun to hike into a fragile stagflationary environment.
Exactly. Capital flows to where the yield is safest. But when positioning becomes that heavily crowded on one side of the boat, it creates an asymmetrical risk.
Which brings us to a critical applied question for your portfolio. If this interim US-Iran peace deal is formally signed at the G7 summit next week, and it triggers a massive sudden unwind of those crowded $27.8 billion in long dollar positions, what does a sudden, violent dollar squeeze mean for the offshore earnings of the U.S. mega caps sitting in your portfolio?
Yeah, that's a great question.
When the dollar rapidly depreciates, the value of revenue generated overseas instantly inflates when converted back to U.S. dollars. That currency tailwind could mechanically restate the earnings power of the S&P 500 upward, entirely separate from their actual day-to-day operational performance. It is a massive variable sitting right on the horizon.
To recap today's core takeaways. The U.S.-Iran peace deal momentum drove the Kospi up over 8% intraday, while sinking WTI crude below $85.
Yeah.
The $75 billion SpaceX IPO executed flawlessly, fueling broad risk-on sentiment and a sharp liquidity rotation out of space-adjacent peers. Meanwhile, the macro bedrock shifted as the ECB hiked rates to 2.25% and the U.S. curve steepened with long-end rates testing critical technical levels near 5%.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back next week with the latest market color. Have a good weekend and make sure to enjoy the World Cup.